The second learning objective is to account for depreciation. Depreciation is the allocation of a plant asset's cost to expense over its useful life. It matches the expense against the revenue generated from using the asset to measure net income. In this example, an $80,000 truck depreciated over 10 years equals $8,000 per year expense. All assets, except land, wear out as they are used. A delivery truck can only go so many miles before it's worn out. As the truck is driven, this use is part of what causes depreciation. Additionally, physical factors like age and weather can cause depreciation of assets. Some assets, such as computers and software, may become obsolete before they wear out. An asset is obsolete when a newer asset can perform the job more efficiently. As a result, an asset's useful life may be shorter than its physical life. In all cases, the asset's cost is depreciated over its useful life. Depreciation is not a process of valuation. Businesses do not record depreciation based on changes in the asset's market or sales value. Depreciation is recapturing the cost invested in the asset. Depreciation does not mean that the business sets aside cash to replace an asset when it is used up. Depreciation has nothing to do with cash. Depreciation of a plant asset is based on three factors: cost, estimated useful life, and estimated residual value. Cost is known and, as mentioned earlier in this chapter, includes all items spent for the asset to perform its intended function. The two other factors are estimates. Estimated useful life is the length of the service period expected from the asset. Useful life may be expressed in years, output, miles, or some other unit. For each asset, the goal is to define the estimated useful life with the measure, years, units, and so forth, that best mimics the asset's decline or use. For example, a building's life is stated in years. A truck's life is the number of miles it can drive, and a Xerox copier's is the number of copies it can make. Estimated residual value, also called salvage value, is the asset's expected cash value at the end of its useful life. A delivery truck's useful life may be 100,000 miles. When the truck has driven that distance, the company is done depreciating the truck. The expected cash receipt at the end of the truck's life and the truck's estimated residual value. Estimated residual value is not depreciated because you can expect to receive this amount at the end. Cost minus residual value is called the depreciable cost or depreciable base. There are many depreciation methods, but three are used most commonly. They are straight line, units of production, and double declining balance. These methods work differently in how they derive the yearly depreciation amount, but they all result in the same total depreciation over the total life of the asset. These three methods work differently in how they derive the yearly depreciation amount, but they all use the same data for the calculations. Capitalized cost is known cost, and as mentioned earlier in this chapter, includes all items spent for the asset to perform its intended function. Estimated residual value, also called salvage value, is the asset's expected cash value at the end of its useful life. Estimated residual value is not depreciated because you expect to receive that amount at the end. Cost minus estimated residual value is called depreciable cost or depreciable base. Estimated useful life is the length of the service period expected from the asset. The estimated useful life is how long the company expects it can use the asset. Useful life may be expressed in years, units, output, or miles. The straight line method allocates an equal amount of depreciation for each year. The formula to compute straight line depreciation is as follows. Cost minus residual value times 1 over the life times number of months divided by 12. In this example, a truck costing $41,000 with a residual value of $1,000 has a depreciable cost of $40,000. Divided by a 5-year life would yield a depreciation expense of $8,000 per year. The journal entry to record the expense is a debit to depreciation expense for the truck for $8,000 and a credit to the contra asset account called accumulated depreciation for the truck for $8,000. An asset's book value equals its cost less accumulated depreciation. As an asset is used, accumulated depreciation increases the book value. As an asset is used, accumulated depreciation increases and book value decreases. The units of production method allocates a fixed amount of depreciation to each unit of output. A unit of output can be miles, units, or output, depending on which type best defines the asset's use. Depreciation per unit is computed by multiplying the cost minus the residual value by 1 over the life expressed in units. To determine the depreciation for the period, multiply the depreciation per unit by the activity during the period. For example, the units produced during the year. In units of production, the depreciation amount changes per year based upon changing output per period. The journal entry accounts are the same for the different amount for each period. An accelerated depreciation method writes off more depreciation near the start of an asset's life than the straight line does. The primary form of this is the double declining balance method. This method writes off more depreciation near the start of an asset's life than straight line does. Note that residual value is not included in the formula. Residual value is ignored until the last year. Final year depreciation is calculated as the amount needed to bring the asset to its residual value. The double declining balance method multiplies decreasing book value by a constant percentage that is twice the straight line rate. The formula to compute double declining balance is as follows. Cost minus accumulated depreciation is multiplied by 2 divided by the life of the asset multiplied by the number of months, hence the name double. Since book value decreases each year, the amount of depreciation expense will decrease over the asset's life. This graph shows the pattern of each depreciation method over an asset's life. In this example, an asset cost $41,000 and was assigned a residual value of $1,000 and a life of 5 years, or 100,000 units. The straight line method, which is blue, results in a constant amount of depreciation each year. The units of production, which is red, results in varying amounts per year because the activity varies from year to year. The double declining balance, which is green, begins with a large amount in the first 2 years, then quickly decreases each successive year. Which method is best? That depends on the asset. A business should match an asset's expense against the revenue that the asset produces. The following are some guidelines. Straight line depreciation. For an asset that generates revenue evenly over time, a straight line method follows the matching principle. Each period shows an equal amount of depreciation. For example, the straight line method would be good for depreciating a building. The units of production. This method works best for an asset that depreciates due to wear and tear, rather than obsolescence. More use causes greater depreciation. For example, units of production would be a good for depleting natural resources like oil and coal. Units of production is also good for vehicles, which is miles, or machinery, which are machine hours. The double declining balance method. The accelerated method of double declining balance works best for assets that produce more revenue in their early years. Higher depreciation in the early years is matched against the greater revenue. For example, double declining balance would be good for depreciating computers. Only the methods that utilize number of months of the year in the formula would change for a partial year depreciation, which means only straight line and double declining balance would change. Units of production does not consider years in its formula, so that calculation remains the same. Since we used an asset for 6 months of the year, we only record 6/12 of straight line depreciation expense. Estimating the useful life of a plant asset poses a challenge. As the asset is used, the business may change its estimated useful life. Accounting changes like this are common because they are estimates and, as a result, are not based on perfect foresight. When a company makes an accounting change, generally accepted accounting principles require the business to report the nature, reason, and effect of the accounting change. For a change in either estimated asset life or residual value, the asset's remaining depreciable book value is spread over the asset's remaining life. Fully depreciated asset is one that has reached the end of its estimated useful life. No more depreciation is recorded for the asset. If the asset is no longer useful, it is disposed of. If the asset is still useful, the company may continue using it. The asset account and its accumulated depreciation remain on the books, but no additional depreciation is recorded. In short, the asset never goes below residual value. This exercise provides practice with the 3 depreciation methods. At the beginning of the year, Alaska Freight Airlines purchased a used airplane for $43 million. Alaska Freight Airlines expects the plane to remain useful for 5 years, or 4 million miles, and to have a residual value of $7 million. The company expects the plane to be flown 1,400,000 miles the first year. Compute Alaska Freight Airlines' first-year depreciation on the plane using the following methods: straight line, units of production, and double declining balance. Straight line. $4 million, which is the cost of the asset, minus $7 million, which is the residual value, divided by 5 years. That's $7,200,000 in depreciation each year. Units of production. $43 million minus $7 million residual value divided by 4 million miles. That's $9 per mile. $9 per mile times 1,400,000 miles is $12,600,000 in depreciation. Double declining balance. First year, 43 million minus 0 times 2/5 times 12/12 is $17,200. The second year, this is where the double declining balance comes in. We take the cost of the asset, 43 million, minus its accumulated depreciation of 17,200,000 times 2/5 times 12/12 is 10,320,000.